What's good, traders and investors? It's Rod with Pow Group. Welcome back on the Pursuit of Wealth. Today is Monday, May 2nd. Hope you're well today. It was the first trading day of the month. It started off a little rocky. We actually ended up closing the day green, but it wasn't all sunshine and rainbows because we did confirm a monthly downtrend. We didn't see a whole lot of follow through, and this was the first time since 2008, so 14 years since we confirmed a monthly downtrend. And I thought it was a fitting day to come on today and do a short video on hedging, what my game plan is, how I'm protecting my portfolio against an inevitable market downturn. And I think the next 6 to 12 months are going to be very, very challenging in the stock market and crypto as well. So I'm being very, very selective with regards to my long-term entries. Before we get to it though, make sure to smash the like, subscribe to the channel. It doesn't cost you anything. It helps support me and the channel. And tick the bell, you'll be notified on any future updates. Before I jump into this, the hedging options and strategies, I want to remind everybody that we have a free giveaway alert that'll be going on YouTube, but we decided to extend it to May 14th. We were initially going to do it on Facebook, but a lot of people were saying that they would rather have it on another platform. A lot of people trying not to support Facebook, and myself included. So going to move that to YouTube, and I'm going to do a live stream on May 14th. So no longer on May 4th, it's going to be on May 14th. And we'll be giving away 2 free annual gold memberships that are valued at $150 each, so $300 total. We'll be giving away 2 free annual memberships to the Pow Group community. And like I said, make sure to tick the bell. You'll be notified whenever we go live on the 14th, and good luck to all the participants. I did a tweet not too long ago. Do you have a game plan? Remember, those who fail to plan to fail. And I know a lot of people when days like today, when the market is down, they have the bury their head in the sand mentality. And a lot of people, they jokingly say, but I think they actually mean it to a certain extent. They don't want to log into their account on a day like today because they don't want to see the numbers, right? They don't want to see the blood in their account. But as the old saying goes, you buy when there's blood in the streets, and even if that blood is your own. And to be honest, when the market is down, that's when I pay the most attention, because that's when the opportunity presents itself, and where we also need to protect ourselves when we've been in a multiple year bull market. Now is the time where we need to start developing these game plans. And if you don't have a game plan, you're likely going to end up emotionally reacting. And that is probably the worst thing you could do as a trader or an investor, is make buying and selling decisions based off of emotion. So I said, consider a hedging strategy. And these are some of my options that I'm using for hedging and protecting my portfolio, like I said, against that inevitable drop and monthly downtrend that we're going to see in the broader market, in the S&P 500, and even in the crypto space. So first, we have a standard short position on the S&P 500. We recommend this for long-term short positions because of the fact that with leveraged ETFs, which we'll look at here in a minute, they use options in order to meet those 3x leverage. So it's a little bit more risky in the longer term. So if you're looking for a long-term short, and I'm talking a month plus, maybe a month to 6 months short, you'll want to consider just standard short shares. And if you don't know what that is, Investopedia is a good friend of yours. But essentially, you're just borrowing shares from somebody, and you're betting that the stock is going to go down. So if a stock drops from $100 and you short it at $100 and it drops to $50, you essentially get to keep the difference and sell those shares back to who you borrowed them from. And you don't have to actually contact anybody. The broker does that for you. So whoever you use, Questrade, that's the official partner of Pow Group. There's actually a link below. You can use them. They have a lot of short shares available. They have options as well. Highly recommended. But again, you can just short the S&P 500. So if the S&P goes down 1% and you're short, you're going to make 1%. Now, we also have short leveraged ETFs. So SPXS is one, SQQQ. So SPXS is a 3x inverse leverage to the S&P 500. So for example, if the S&P 500 goes down 1%, you would make 3% because it is 3x inverse leverage. But on the flip side, if SPY goes up 1%, you lose 3%. On Friday, I had an SPXS position, and the S&P 500 was down almost 4%, and my SPXS position was up about 12% because it's 3x inverse leverage. So that's how you can protect against these downturns in the market. A lot of people think you can only make money when the market is going up. They only know how to hit the buy button, but there's also the sell button. There's short positions. There's 3x inverse leverage. You can also use options, so you can use put options. Again, I'm not going to get too much into detail with these. Investopedia is a great place to start if you want to learn more. There's also the volatility index, so the VIX, which volatility has been picking up drastically over the last several months, really since the beginning of the year, with the S&P 500 down about 15% from the all-time high at about 480. There's also the tried and true, simple, but not a lot of people are very good at holding cash because they get FOMO or they, all these other reasons. But essentially holding cash right now, I think, is probably one of the best strategies. And actually, I did a video. You can check that out. I did my portfolio breakdown, and I'm currently holding 50% of my investment capital in cash. I've got 20% in real estate, 15% in cryptocurrencies, 10% in MJ stocks, and then the rest into mutual funds. Mutual funds. So what are mutual funds? Mutual funds are very similar to an ETF. An ETF is an exchange traded fund that tracks a lot of baskets of stocks, right? So you could have 50 stocks in this basket in this ETF, but an ETF, it trades like a stock. It's on a stock exchange. It trades at the same hours as the stock market. So when you hit the buy or sell button on an ETF, the price fills right away, and that's what it settles at, right? That's fill price. But with mutual funds, it's similar in the fact that it has a basket of stocks or securities. But essentially, mutual funds only trade once at the end of each business day. So if you execute a mutual fund trade, let's say you switch an investment or you sell something, it doesn't actually execute that trade until the end of the business day. So a little bit different, but essentially I have mutual funds as well, retirement accounts. And I've switched all those over to a money market fund. A money market fund is just a low risk, more treasuries, maybe, types of bonds and things like that, low risk investments. And generally when the market sees huge volatility and downturn, money market funds are similar to cash, right? You might only drop 4, 5, 6, maybe 8%, 10% at the most if, we saw a huge stock market crash. But if you were in mutual funds that were aggressive growth or a balanced fund usually uses about 60% of equities and just a little bit more of a balanced approach, right? It's in the name. Aggressive, you're using a lot more equity, so stocks, for example. And if the market were to completely collapse and we had a stock market crash, if you're holding an aggressive mutual fund, you could potentially see your mutual fund drop by 40, 50, maybe even more percent, right? So I'm personally all in. About 95% of my money market capital in my mutual funds are, the capital in my mutual funds are in money market. And that's just very, very low risk. I don't want to give back any of those gains that I've made since March 2020 and just waiting for that inevitable market downturn. I was actually going to add to the aggressive. I was going to switch from money market to aggressive today, but because of the fact that we bounced so much into the end of the day, I'm going to hold off. I'm being very selective with my long-term entries. And again, just being very protective. And I wouldn't use the whole account either. I'd probably only use at the most 75 to 60%. There's also short options on crypto. So Bitcoin, you could take a short position on Bitcoin, which we have a partnership with Bybit. The link will be in the description as well. But essentially, you can take short positions. You can do inverse leverage. You can do leverage as well. So you can do up to 100x leverage, which we don't recommend doing. If you're new, we only recommend that for very, very experienced investors. So again, let's just take a look at the S&P 500. We confirmed a monthly downtrend today for the first time since 2008 with a lower high and lower low. Granted, we didn't see much follow through, but the reason why I wanted to do this video is to prepare everybody that we could see a lot more downside from here. Personally, I overlaid the .com bust fractal, and if we follow what happened in the .com days in the 2000 era, we could easily see a drop on the S&P 500 into the next couple of years. And is your portfolio prepared for this type of drop? And if we see something similar to what happened in the .com days, we could drop over 50% on the S&P 500. So once again, is that something that you're prepared for? And that's why having these hedging plans and having a game plan is so important, right? And again, we haven't confirmed a monthly downtrend in 14 years, and here we are confirming that monthly downtrend. And things can get a lot worse. Just when you think it can't go any lower, it absolutely can. And again, I'm not on here to spread fear or FUD, uncertainty and doubt. I'm just literally telling you how it is, what I'm doing, and how I'm protecting my portfolio. And the best way that I can protect my portfolio right now is holding 50% in cash. Like I said, real estate, cryptocurrencies. I'm going to be looking to add a lot more MJ stocks. And that's why I'm also hedging. I've got positions on SPXS. So let's bring this up here. You can see it's a S&P 500 Bear 3X. So given the fact that SPY has been down 15%, look at how much SPXS has been up. It's been up over 53% just in the last couple of months. So again, it's inverse to the broader market. SQQQ is a inverse leverage to the tech sector. And just look what's been happening over the last couple of weeks because of how weak tech has been. Just over the last month, we were up over 54% on this inverse leveraged ETF. From the lows here to the high, we were up almost 100%, so about 90%. So again, there's more than one ways to make money there's more than one way to make money in the stock market. You don't just make money when assets and prices are going up. You can also make money when things are going down. So again, that's just a couple of options that there's tons of them out there, but those are some popular ones that I use. And then, like I said, you can also use the volatility index, so the VIX. And again, just look over the last month or so, we're up about 100% on the VIX, right? So these are all different strategies that you can use, and it really has to depend as well on your experience level. If you're somebody who's new to the market, maybe you want to just start with something simple like holding cash. And if you're struggling at night to sleep, if you're losing sleep and you're not really sure what you should do, maybe you're a little bit too heavy. Maybe you went and you broke the golden rule. Maybe you invested a little bit more than you were willing to lose. So again, if you're having trouble sleeping at night, if you're just constantly staring at the charts, maybe you went a little bit too heavy. And again, not financial advice. Maybe you could sell a quarter of that position or a half of that position, and then that way you're sitting on 25% cash or 50% cash, and then that way if the asset that you're investing in continues to go up, you're right either way. If it goes down, you have cash on the side. Maybe consider using the dollar cost averaging approach as well. That's a form of protecting yourself and your account against an inevitable market downturn. If you dollar cost average and set entries that you're going to enter at, that way you're able to get these better prices as you average in, right? Instead of just doing a lump sum. But again, there's multiple different ways that you can protect. You can also set stop losses. But again, just for the sake of this video, it's getting a little bit long at the moment. Let me know in the comments below, though. Do you have a hedging plan? Was this helpful? If so, let me know what strategies you're going to be using. Always love hearing from you. Thanks so much for joining us again on The Pursuit of Wealth. If you could, on your way out, smash the like. It helps support me and the channel. It doesn't cost you anything. Subscribe and tick the bell. You'll be notified on any future updates. Like I said, going to be giving away 2 free gold memberships, annual memberships to the POW Group community that are valued at $150 each. That'll be on May 14th, and we'll be doing that on YouTube Live. We'll be doing a live stream to give those away to two lucky participants. So good luck to everybody. Have a great night, and we'll see you again on the next video.